So far this year, the London Stock Exchange LSE has only managed to raise an amount equivalent to that of Kazakhstan in initial public offerings IPOs, causing it to slip in global rankings. According to Merger Markets analysis, London's primary market shares the 21st spot for capital raised by new listings. In the first quarter of the year, there has been a single IPO, which raised a mere £95 million 119M. This was a joint float by Air Astana between London and Kazakhstan. This lone float implies that London Stock Exchange, which has a history spanning centuries, has only managed to raise as much as the 30-year-old exchanges in Astana and Almaty of Kazakhstan, the world's 54th largest economy. It lags behind several smaller exchanges, including Istanbul, which has raised 486M, Athens with £638 million, and Oslo, which has had a single float raising £111 million. In total, around 370 IPOs have raised $32.3 billion in the first 4 months of the year. The London market has been impacted by a series of companies choosing to list overseas, such as in New York. Last year, mining behemoth Glencore opted to spin off and list its coal business in New York instead of London, with its secondary listings going to Toronto and Johannesburg. Recently, there were concerns that FTSE giant Shell was considering a move, with a top executive stating that all options were being considered, although this has since been downplayed. Initial public offerings are instances when a company offers its shares to the public for the first time, allowing it to raise capital. However, London has been struggling to attract such floats for a while. Last year was a challenging one for the British market, with London having 8 floats that raised a total of £728 million, just above Tokyo, which raised a mere 688M from 21 floats. It was the worst year for IPOs in London since the financial crisis. 2023 was also a dismal year for European markets, but there are glimmers of hope. Shares in the European private equity firm CVC soared by up to 25% after making their debut in Amsterdam last month. There is also some optimism for London. Companies ranging from Boots to EE Bank, Starling, and buy now pay later giant Klarna are eyeing the British capital for their IPOs. Other fintechs, including Zilch and Zopa, are also mulling potential floats, although many are waiting for the IPO flow to pick up first. There are also concerns about the uncertainty caused by an impending general election. Analysts at Peel Hunt, who provide an IPO speedometer, say the signs for the second half of 2024 are more positive and anticipate a broader reopening in the first 6 months of next year. Lindsay James, an investment strategist at Quilter, expressed concern about the trend of companies leaving the UK market for the US or through acquisitions. She said that while the departure of some notable firms and the decline in new floats is a setback, the cumulative impact of multiple companies leaving would signal a more significant threat to London's financial standing. She pointed out that the UK index faces unique challenges, including a lack of large growth companies, an underrepresentation technology stocks, and the reduced role of UK defined benefit pension funds in ownership. Additionally, stringent regulations may deter companies from listing, presenting a hurdle that needs addressing. The London Stock Exchange Group LSE, established in 2007, made over £7 billion in profit in 2023, but only 3% came from the exchange. LSE is a leading global financial markets infrastructure provider offering services across the entire trade lifecycle. The London Stock Exchange is a crucial part of the group, and it is incorrect to suggest otherwise. All entities across the group benefit from our diversified business model and robust balance sheet, enabling investment in growth and transformation. Last month, fears were raised that FTSE giant Shell was contemplating a move with the senior executive saying all options were under consideration, although it has since played down the suggestion. European defense stocks see worst day in about 18 months. Bloomberg on multiples that are a little bit higher. European defense stocks Inc. to mark worst day in 18 months. Initial public offerings IPOs are when a company makes its shares available for the first time to the public, allowing a firm to raise capital, but London has long been struggling to attract floats. While the exit of some notable firms and the decline in new floats is certainly a setback, it is the cumulative impact of multiple companies departing that would signal a more substantial threat to London's financial standing. The UK index faces distinct challenges, including a scarcity of large growth companies, an underrepresentation of technology stocks, and the diminished role of UK defined benefit pension funds in ownership. Additionally, stringent regulations may deter companies from listing, presenting a hurdle that needs addressing, she said. All entities across the group benefit from our diversified business model and strong balance sheet, enabling investment in growth and transformation.